This is a brief overview of Chapter 1 from the Finance book. Please just use this as an introduction. A lot more information is contained within your book, and it's very important that you read all of the information. The first slide that you'll come across in your Angel folder will be an introduction to what all is in Chapter 1, which includes a discussion of the different forms of business organizations, how stock prices different from market values versus the intrinsic value, how those are determined and how that all plays into executive compensation. Also a discussion of some important business trends over the last few years and conflicts between the manager stockholders and bondholders. The second slide gives an overview of how most organizations are charted out, beginning with the top level of organizational management being the board of directors, which generally then oversee and hire the chief executive officer. From there, there may be a whole level of directors or vice presidents, but two of the most prominent and most important for us are the chief operating officer, which is obviously involved with the operations of the business and has as reporting to them generally the marketing, the production, HR, and many other areas in those folks that directly deal with the business that they're in. On the flip side of that is the chief financial officer, which is more of a staff oversight, which includes the accounting department, the treasury department, credit, etc. So kind of the two halves of the organization reporting up to the chief executive officer is what you see on the visual. The third slide just introduces the three primary forms of business organization. There are many more categories under these, particularly under the corporation itself, but the book then highlights a few things about the proprietorship, partnership, and corporation. Proprietorships and partnerships, for the purposes of our book, are lumped together because the focus of your book will really be on the corporations, but just as a way of distinguishing between corporations and the proprietorship and partnerships, some of the following are important notations. One of the advantages is both proprietorships and partnerships are very easy to form. Proprietorships, typically there's absolutely no paperwork required except that you track your expenses and your income and report them on your income. With a partnership, you have to have a legal binding partnership agreement that sets out the partners and what percentage that they own. If it's two people and they share equally, then each person would be entitled to 50% of proceeds and also be liable for 50% of the expenses and debts. So in either case, they're very easy to form. Not a lot of regulations from the government and no corporate income taxes for proprietorships and partnerships. There are taxes, but those taxes are simply folded into each proprietor or partner personal income tax. Difficulties or disadvantages are that there's no real good way for a business such as this to raise money outside of loans in personal investment, as we'll look at it in contrasting corporations, which have the ability to raise outside money by selling shares of ownership through stock. And then unlimited liability, in that your personal assets are at risk with a proprietorship and a partnership, and more with a partnership in some sense, in that something that your partner does can reflect back onto your assets, so very difficult to control. And then a limited life. Partnerships and proprietorships end with the death of the proprietor or one of the partners, so then you must go through the process of reforming your business. Corporations, on the flip side, have kind of the same disadvantages become advantages and vice versa. So unlimited life, in that the corporation is not dependent on any one person owning the business. The shares will still exist and will be moved through their heirs. It's easy to transfer the ownership. You can sell shares of stock or gift them. Limited liability, it's a little bit of a misnomer, but if we look at it from the big picture in general, most investors are limited in liability to the amount they invest within the business. So there is less likelihood that your personal assets could be claimed in the event of bankruptcy, etc. much easier to raise capital because with a corporation you now can sell shares or pieces of the corporation and decide how much control you're giving those shareholders. Primary disadvantages are double taxation. Corporations are taxed separately as a separate entity, which is why they have the unlimited life. But then as those profits are distributed to shareholders through either a partnership or through a distribution or through a dividend, then the individual receiving that are also then taxed again. And they can be very expensive to set up and to do the required reporting and filing through the government, both the federal and the states. So it's something that generally will require some legal assistance. A little discussion now on the stock prices and shareholder value, and one of the keys is that when we ask what's the purpose and the goal of a business from a finance perspective, it's always to maximize the stock price. That's what the business managers should be doing, is to working for their shareholders, and the shareholders ultimately should be most interested in a long-term healthy stock price and growth in that stock price. When you compare, how do you figure out what a piece of paper that tells you that you're a shareholder is worth? It's difficult. It's not like what's your house worth. Your house has value. It provides shelter, it provides a place for your family together. A piece of paper that you get as a shareholder doesn't have any value except as it represents the future rights to cash flows. Therefore, as a manager, one of the most important things to keep in mind is that all significant decisions need to be evaluated based on what their implications are for the finance end. Stock prices do change over time, sometimes for good reason, sometimes because market conditions are not good, economic conditions are not good. Sometimes it's because of emotional issues. Certainly anyone who's old enough or read enough about 9/11, there was no significant business damage done on September 11, 2001, but significant emotional damage done to the country. And the result was that many people pulled their money out of the stock market, which resulted in stock prices falling dramatically, even though it wasn't necessarily for a business reason, really more for a governmental and an economic, emotional reason. We try to distinguish between market price, which is the price that people are willing to pay, and that in the U.S. is how prices are set, and what's the intrinsic value, what's the true value. And intrinsic value is a mathematical concept and something that we'll cover in Chapter 9. It talks about the long-term value based on the cash flow coming from the company. But investor perceptions can be very far off at times. Certainly we saw that with some of the collapses of some of the large businesses such as Enron, where they were valuing a company that really had very few assets and significant debt at $80 and $90 a share, when its true value was probably a few dollars. And that was simply because of perceptions. The company did a very good job of publishing and promoting how sound the company was when it wasn't. So one of the key points here in the fourth bullet is that managers have to be aware of the long-term intrinsic value of the stock, and make sure that those decisions are impacting the stock price in the appropriate way. This is just a graphic that you'll find in your book, and it simply talks about there's two sides: the true value that you have on a company, which is difficult to ever know. We never know for sure what the true risk is with a company, which decreases the cash flows because of the risk of not getting that. We never know exactly what the cash flow will be. And then there's the perceptions. What do people think out there in the marketplace? And that determines what the market price is. When those two are close together or equal, we say that that particular stock is at equilibrium. Important business trends. This book's a little bit dated at this point, but certainly we are still seeing the impact of corporate scandals, in part because of Sarbanes-Oxley, which required a great deal more reporting, a lot of regulations on corporations, and those are expensive. So those have had an impact on stock prices long term. Globalization continues and will continue as more and more businesses go beyond their own borders, and that basically flattens the market out. It's also key for financing businesses as the capital markets have become much more open, so you aren't limited within your own country if you need to raise money. And then IT, the technology, the ability to transfer information very quickly has had a very big impact on business. This next slide doesn't use the term agency problem, but it's a common term used, and it's simply the fact that managers don't always act in the stockholders' best interests. Most of us act in our own best interest, and so managers tend to do those things which will increase their own year-end bonuses, or optimize stock options that they might have, something that we'll discuss later. So some of the ways that we try to control that is to make sure that our compensation packages are designed in a way that will limit inappropriate actions. Shareholders can directly intervene. They can go to shareholder meetings. They can fire the managers. They can try to elect board of director members that will be more cognizant of their own needs. The threat of firing is always there from the board of directors. And then finally, inappropriately managed companies are often the target of takeovers from corporate raiders or from other companies. And then there's also an additional final conflict, and that's the conflict between stockholders and bondholders. Bondholders are those people who have invested money in a debt situation to the company. They have bonds or IOUs that provide interest back to them. And what bondholders are interested in is good, steady income, good earnings by the company that will allow them to pay the interest as it comes due, and then finally repay the debt when it is due. Shareholders tend to be interested in perhaps taking more risk and having more risky projects because of the ability for a greater return. So if you look at a super successful company, if you look at a company like a Google, who originally sold for $87.50 a share and went as high as $700-800 a share. That's because they were in a high-flying market and taking a lot of risk, and they still continue to do that as they continue to take over more and more different software companies, which is good for the shareholders. You might have increased your holdings by tenfold. So if you put $10,000 in it and it goes crazy, then you end up with $100,000. And bondholders, on the other hand, are still locked into whatever interest that they agreed to in the first place. So they're less interested in the risky projects, and so this can create a bit of a conflict. And one of the ways that bondholders kind of can protect themselves, and this is done with the advice of investment bankers in the company, is to try to make sure there are good covenants within the bond agreements, which are called indentures, so that the company is limited on taking on additional debt, and also constrains somewhat their managers' actions, such as paying dividends or investment in certain risky projects. So that's just a quick overview of the first chapter, so hopefully you'll find that helpful. And still read your chapter and take a look at the notes that I've posted, and do any of the problems or questions in this particular chapter, submit them if that will be helpful, and I'll take a look and make sure you have good understanding before you take the exam. Thanks.